Let's break down the current economic situation in Europe, particularly in light of recent remarks from Francois Villeroy de Galhau, the governor of the Bank of France and a key member of the European Central Bank's ECB Governing Council. Before diving deeper into the satire, let's first frame the broader context of monetary policy, macroeconomic sentiments, and how the specter of looming recessions looms large over Europe. Here's the latest big headline. Francois Villeroy de Galhau has openly hinted that the ECB will quite probably cut interest rates in its next meeting, set for later this month, a notable shift in the central bank's economic strategy. The comment has produced shockwaves for a straightforward reason. Just a few weeks ago, expectations of a rate cut were near zero, but now the market is pricing in a 90% likelihood that a rate cut is looming. You might think this is all part of the usual inflation-fighting strategy. But hold your horses. Things are getting murkier behind this economic curtain. Inflation has fallen below the ECB's 2% target for the first time in years. Inflation measures in September showed a significant cooling off, signaling an economic downturn that many have either conveniently ignored or grossly underestimated. Inflation, which once tormented policymakers with its relentless upward surge, is now showing that its menace can just as easily reverse. A downturn in inflation forecasting poses long-term risks to business investments, corporate profits, and economic growth as a whole. Sounds simple enough, right? Well, almost. Instead of relief, what we're really looking at is a brewing economic quagmire that stems not from fiery inflation but from the ECB flirting too long with restrictive policies, possibly strangling economic growth back at a time when Europe's economy is already on shaky footing. Welcome to the paradoxical world of central banking, where trying to hit an inflation target at gunpoint has transformed into a symphony of discordant trade-offs. Now that the ECB has seemingly tamed inflation, the spotlight shifts to the dangers of deflation and stagnation because inflation measures now sit below the target. De Galhau himself outlines precisely that risk. The balance of risks is shifting. Before, our main worry was overshooting the 2% target. Now we face the recession-level risks of prolonging restrictive policies. Let's step back for just a moment to understand why this inflation conundrum is exactly the headache it is. You see, inflation targeting sounds like a good, simple idea. Keep inflation around 2%, not too hot, not too cold. If it rises too much, central banks raise interest rates to keep prices from getting out of control. But if inflation falls below that 2%, central banks might bring rates back down to try to stimulate demand across the economy. However, the situation we're in now reveals economic contradictions and limitations. While inflation harmed household budgets severely throughout 2022 and early 2023, Europe is now looking down the barrel of slowing growth paired with fiscal tightening measures. Much worse, current ECB policies could actually exacerbate the slowdown if they hold onto high borrowing costs too long, choking any attempts at spurring investment, consumer spending, and entrepreneurship. Therein lies the core criticism. The ECB's rate hikes thus far have worked wonders to curb consumer price inflation, with the latest readings showing inflation sliding below 2% for the first time in 3 years. But what next? Villeroy himself mentions that forecasts for inflation in 2025 are less than 1.8%. These figures aren't just benign. They spell potential deflationary risks, something economists fear possibly even more than inflation. Deflation is an insidious economic condition where falling prices disincentivize consumers from purchasing goods and services, worsening slowdowns and leading to worse employment and investment figures. Which brings us to the million-euro question. Is the ECB's restrictive stance helping the economy or undermining it further? We're on the edge of moving from an inflation scare to a growth scare. Governments that were once absorbed in reeling in inflation are now having to face the even more difficult challenge of dangerously sluggish GDP growth projections. Investors already show signs of concern, as reflected in their almost certain betting that the ECB will budge and make the monumental call to reduce its borrowing costs. When you pair the monetary policy discussion up with Europe's broader economic conditions, the financial commentary gets a lot more dire. Europe isn't out of the woods yet by a long shot. The continent still battles multiple overlapping and compounding crises, including the ongoing effects of the Russia-Ukraine war, an energy crisis flared by geopolitical tensions and macro shocks from commodity price volatility, particularly in oil and gas markets. Let's delve a bit deeper into how faltering growth plays a critical role here. European manufacturing, traditionally a linchpin of steady economic growth, is falling apart. Germany, the Eurozone's economic engine, has shown worrying signs of contraction, particularly in the realm of industrial production, with the closely watched Purchasing Managers' Index, PMI, signaling bearish prospects, consistently reading below 50, a mark indicative of contraction. Moreover, unemployment, though holding somewhat steady for now, still looms as a danger should the stagnation continue, especially as ECB policies keep waiting for the other shoe to drop. The more Europe's businesses feel the weight of higher borrowing costs, the more sluggish their expansions become. What's next? Corporate bankruptcies? Higher unemployment? Declining consumer confidence? Don't believe me? Look at business investment figures. The corporate sector in Europe is wary because of tight monetary policy paired with low economic returns. Many businesses are pulling back on spending purely because they do not see any growth-driven return on investments. If businesses delay expanding and hiring plans, economic malaise risks becoming a self-fulfilling prophecy. By choosing to remain cautious and project lower inflation even into 2025, the ECB admittedly allows risk rest to nestle deep within the system. They've decided to play defense tightly, and by extension, slow the bounce-back pace of Europe's economy. Now, some of you out there might wonder, wait, but aren't falling inflation rates a win for consumers across the board? Yes, but let's not celebrate prematurely. Inside this ongoing narrative, you have the convoluted impact of oil prices at play. De Galhau has pointedly brushed off concerns about rising oil prices due to tensions in the Middle East, calling them a temporary development. Classic bureaucratic patronization, if you ask me. Here's why this is naive at best and economically dangerous at worst. While most core inflation indicators inside the Eurozone might ignore oil as a short-term volatility factor, a noticeable spike in oil prices nevertheless does cause a spillover into prices of goods produced using energy, transportation, manufacturing costs, and even consumer goods. Translation: higher oil prices can, and do, trigger increases across a spectrum of different product baskets. Beyond short-term pain, these rises crack into fragile consumer sentiments. Take this for instance. The Brent crude oil hit highs upwards of $95 plus per barrel in recent months, bouncing from geopolitical tensions surrounding the Middle East. Consumers feel that pain at the pump, and it ripples throughout the wider production apparatus of the economy. Oil market fluctuations are shaping up to present another key challenge across European economies, particularly for countries heavily reliant on energy imports like Germany, Italy, and even France. Villeroy's apparent nonchalant stance on the matter suggests an overconfidence that these oil shocks won't spill into core inflation, a strategy that could backfire immensely in the coming months if energy prices remain unstable. So, what do we take away from the ECB's looming decision to cut rates? In all likelihood, they will proceed cautiously, but the reality is that bringing these rates down could still fall dramatically short of remedying deeper structural issues within the European economy. Let's think about it in more shocking yet straightforward terms. While inflation may now meet an arbitrary target, Villeroy and the ECB risk blowing a hole in Europe's fleet as it sails through these stormy economic waters. Europe stands at a dangerous crossroads. The economy is slowing, growth is showing no signs of improvement, industrial output is waning, and consumption is softening. By cutting interest rates, the ECB might be attempting to avoid some economic fallout, but how soon before it realizes that it merely applied a band-aid over a potentially gangrenous economic wound? They've managed to put out the inflation fires, but what happens if they cause a catastrophic economic freeze from stifled growth without any meaningful long-term reforms? The ECB is caught between the jaws of deflationary collapse and potential inflationary shocks, particularly in energy markets. Cut rates too slowly, and they'll crush growth further. Overreact to temporary dynamics, and they'll fail to address growing structural weaknesses across the European periphery. In short, the ECB's incoming rate cuts may be quite probable, but this might only be the beginning of a far harsher economic narrative in Europe. Let's hope Francois Villeroy de Galhau and his ECB compatriots don't wake up to an economic reality that no rate cut can solve simply because they focused on tactical maneuvers and forgot the bigger picture. The choices now will either solidify Europe's recovery trajectory or leave it languishing for years in economic limbo. Stay tuned to see how this delicate balancing act plays out.